I want to start with the banking crisis and ask you to explain just for a moment to our audience why these two banks have failed, Silicon Valley Bank and Signature Bank.
Like any big accident, there are multiple causes. The first is that we now live in a digital world with high interest rates. And that means that people are going to be much more reluctant to keep their money in places that are paying them zero interest rate when they could get 4 or 5% interest somewhere else. And they're going to be much more quickly moving to adjust, particularly if they become alarmed about whether they're going to get their money back. That's the first part. The second part is that the banks that held these accounts invested their money in assets that went way down in value. They made risky loans, and much more importantly, they invested in long-term bonds. And when interest rates went up, the value of those long-term bonds went down. So depositors looked around and they saw that the assets backing their deposits were going down in value. They saw that it was easier than ever before to move their money somewhere else. And they saw that they could get higher returns elsewhere. And they saw that because of digital procedures, it was easier to open accounts elsewhere. And all of that came together to cause massive withdrawals. And just as 100 people all trying to get out of a theater at the same time in a big hurry would cause the other 1,000 people in the theater, even if they didn't really know what was going on, to try to rush out as well. That kind of mob bank run psychology took over at these banks. And then we had the situation that we did of a mass run that required the government to step into the situation.
Who has acted most irresponsibly around this?
It's a race. There are a variety of candidates, but I would say the gold medal for incompetence goes to the management of SVB, which grew its deposits at a spectacular rate, didn't have a chief risk officer for 9 months, ignored a multiplicity of warnings about its interest rate mismatch, didn't engage in the most basic kind of bank planning that junior analysts are taught, and had the hubris to regard itself as a heroic, worthy institution. I think the silver medal for incompetence probably goes to the Federal Reserve System in its regulation of Silicon Valley Bank and beyond, because that regulation didn't stop this accident that was waiting to happen. And the authorities had plenty of authority to have forced it to raise capital much earlier, to have stopped it from paying dividends, to have forced it to interest rate hedge, to have done a whole variety of things. The progressive critics are right that almost everything in the Trump era legislation that Congress passed, moving to lighter touch regulation, was misguided.
On not the biggest banks. This was on like the medium-sized
on the medium-sized bank.
Yeah,
that was bad.
Right.
That was bad, misguided legislation.
For most of the people that are watching this right now who don't have money directly at stake, why should they care?
They have a stake in the broad economy, and when there are challenges to the banking system, that affects the flow of credit, which affects everything from their mortgage to the financing of the inventory at the stores where they shop, to the ability of their employer to get credit. In many ways, the financial system is a little bit like an anesthesiologist. Nobody much notices the job they're doing until something screws up. And then it becomes highly salient and highly visible. And that's what happened for people who were worried about meeting payroll at SVB a couple of Mondays ago. And that's why we regulate and insure financial institutions so that people can go about their business without worrying about whether they're going to be major failures.